Hey everyone, and welcome back to the TraderLion channel. This is Richard and Ross, and this video is the start of our America's Greatest Winners series, where we're going to be going through a bunch of the charts from the best winning stocks of all time, talking about their stories, their charts, how to manage it, and key takeaways along the way. And to start off the series, I thought we'd go through a stock that Ross, you actually traded back in the 90s, Charles Schwab. It's going to be a great video. Remember, if you do enjoy it, please go ahead and leave a like down below and subscribe if you're new to the channel. And why don't we get started and bring up that document, Ross, and we'll start off with talking about the story of Charles Schwab, which is really what started this whole impressive run-up.
Absolutely. So starting back here with this cup and handle, which we see came, but prior to that, we were building a nice base that attempted to break out. We've discussed before, straight up off the bottom, quite often fails and retests. In this case, it completely failed. When we get a more detailed view of the market, we'll see the market was under heavy pressure during this leg down, hence the super steep cup. And we'll see also that's why we've got the super steep handle. We had very sharp correction in the market, and we'll get into here where Schwab's handle actually, and which is why it became a handle, holds well above the low of its cup, whereas the market sold off so sharply at this point, it made new lows while Schwab held. So just while we're talking about it, there's your first example of relative strength. Now let's step back to the story. So now we're talking 98, 99. This was the internet boom. It became a point where anything with .com on the end of it, it was flying. It was a little bit insane. So Charles Schwab, on the other hand, not only was a big solid company with legitimate earnings, they had the story thing going on. They were really changing the way that we lived, worked, traded. Essentially, they were the first big online broker. There was a point where there was no such thing as online trading. So commissions came way down. You could place your own trades. So this was a truly legitimate stock that when it became .com, it wasn't just, hey, it's got .com and high relative strength, let's give it a shot. This had the story, the earnings, and the buzz attached to it. So not surprisingly, a discount broker, went up roughly from the teens to almost a tenfold move from the lows of that base. So we can see we got the 1998 follow through day. Schwab broke out on that follow through day. So fortunately, I had been at O'Neill at that point. Certainly doesn't hurt sitting in meetings with Bill every day. So as you mentioned, Richard, this was, this happened to be one of the stocks that I was on top of, knew the story, and happened to catch that breakout that day. I would tell you this also, it was much easier to put on a full position at this time. You could, if you were doing well, you could get away with putting on maybe 30, 40% right off the bat and getting away with it. The market cleaned up a lot of your mistakes. And I would say the market today, you have to be much more selective with getting long more than a couple percent past, where here it almost became to the point, if you weren't on top of it and willing to pay up at least that 5%, sometimes or more, you just missed it. So it was much easier to pay up for stocks at this point. I would just tell you that. So, and anyway, I can't remember 20 years ago exactly perfectly. I guess this is going back over 20 years ago now, but I managed to get a full position on right as it broke out, right as the market followed through. As you can see, there was no genius in it. The stock held its 50-day moving average throughout the entire length of its run. We're not showing where it breaks here. We can look at that in a little bit. And you'll notice the big winners. I mean, time and time again, they've got the earnings, which we'll get into the story. And for the most part, they're usually liquid names with big, high quality institutional sponsorship. And that's typically what lends to the organized patterns and the stocks that hold up at key moving average and logical areas of support, prior pivots, tops of bases, that sort of thing.
And looking at this document quickly, these are notes from O'Neill about a bunch of different stocks, and we're going to be going through in the series a whole bunch of them. And he actually lists here on the right-hand column the kind of key statistics at the point of the breakout. So he says RS rating was at 96, EPS rating was at 91, return equity was 29.4%. If you scroll down a little bit, we can see more info about it. They talk about ownership a little bit, fund ownership, how the pre-tax profit margin was 19.5%. So the fundamentals, the price action, everything was kind of combining together at this moment where we got the fall through day, which is always something that we like to look for. And really just looked like a great opportunity, both from the fundamental point of view and also the technicals.
Absolutely. It's a little harder to get into the nitty. It's hard to see, other than here coming out the top and here coming out the top. There really wasn't much place to add. If you're trading on a weekly, we'll get a more granular look on a daily in a little bit. I guess, the things to point out here, we see Schwab breaks out and goes on a climax type run. I mean, it's a straight up move here. You've got your largest weekly spread. If you look back on the daily, I'm going to guess that there were some quote unquote exhaustion gaps along the way.
Right.
However, one of the big rules, if you ask Bill, is this a climax? Is this a climax? And he'll tell you it's just too far or not far enough from the breakout to be an actual climax. For starters, you've got to be at least, if I'm not mistaken, one of the rules for Climax Run is it should be at least 18 weeks or more from its breakout. And here we're only 12. Also, you've got to keep in mind, we're looking at stocks that were breaking out and going much more than double without this sort of earnings, without the story so you're going from you're breaking out roughly 30. And at this point, you're in the 60s. Yes, a double is a big deal in just a few short weeks or, a couple of months there. However, given the nature of the stock, the nature of the market, what was going on with these kind of stocks, it just, and the fact that it was only 12, not 18 weeks, despite, having those other characteristics of what a climax might look like, it wasn't classified as a proper climax top. Did I figure that all out by myself, or did Bill? I'm going to tell you the truth. I was 20 something, and I promise you it was great to have Bill reminding me of all of this stuff along the way. So that was a huge benefit of being there, obviously, with him. And this is a stock he had a close eye on. So that didn't hurt. So anyway, when we did finally get to the climax top, I was actually on the road. At this point, so long story short, I was standing in front of CNBC. I guess I was watching I had it on. I was watching the ticker. I forgot they were talking about it. And I was literally cheering for Schwab in front of the TV set. And I walked over. It took me maybe a minute or two to go, wait a minute. I was like jumping up and down, cheering for Schwab. I immediately grabbed the phone, called my trader on the desk by the time I called. So I sold top day. Stock was down by the time I sold. I didn't get the top price. I didn't even sell it while it was up that day. But I had enough confidence to go, you know what? It's gone a ridiculous amount. I literally was just cheering in front of the TV set. And I just sold everything at the market. And sure enough, I would tell you this also, so you're watching around, other stuff is climaxing. You're seeing this stuff happen around you. You have Bill talking to, so it was great. I mean, how lucky was I? I can't begin to tell you, to have it drilled into my head every day. And then to, be that young actually and realize it was time to, that was the beginning of fading myself. So, but yeah, you can do it when you feel, those massively emotional times, when you're feeling that and your heart lights up, or you get dreadfully, sick to your stomach, your times of elation and fear. And so anyway, that was one of a few times that fading myself has worked. I don't know, just recently, I don't know did we discuss this already? Maybe it was, I was telling you earlier, just last week, as we're watching the market, some of these old leaders really fall apart. I was watching the software stocks, which had really, big leaders through 2020, falling apart, making lows. And I can't tell you, you probably know, I had a list of software names that I wanted to, I had 3 of them. I wanted to put a few small shorts on so badly that, the itch, I knew it. The itch was so bad. I called myself out. I'm like, we're within a day or 2 of the bottom, and no joke,
Right.
we were right there. It couldn't have been more than 2 days. I probably would have been profitable for about 13 minutes, watched them bobble around, and then covered them all for losses as the market ripped in my face. So,
right.
It works, as you learn yourself.
Help.
Yeah, it works. Keeping track of your own emotions, learning, and trading will bring the worst out of you, the best and the worst out of you. You'll get the most excited, but you'll also get extremely upset when you watch that hard-earned money disappear, or you make a mistake and a lot of it disappears quickly. So,
perfect.
I digress.
Yeah, no problem. So before we go over to MarketSmith and really take it day by day, and really talk about the RS characteristics that it was showing before this breakout, do you have anything that you want to talk about in terms of the earnings and sales maybe of the stock before?
Of course.
It's super strong uptrend.
Yep. So right at the beginning of the breakout here, you'll notice, we've got 3 quarters. We dipped to 0, but we've got 3 quarters of acceleration. We've got our minimum, 25% growth in this quarter, right as the cup and handle is built before the breakout. And no doubt we see it pick up within 3 quarters. We're up at 113%. So you've got that big acceleration, which makes sense given what was going on with the company. We don't have revenues here, but I'm going to guess that revenues were at least supportive of those earnings. So anyway, we won't be able to take a look, because when we change date on MarketSmith, that will disappear. So anyway, but other than that, you had the relative strength, the story, you had the .com buzz, and it had all of the fundamentals in line, and this one definitely had some solid institutional sponsorship, if I remember correctly. So
absolutely. And it was a first stage base, because the cup and handle that started everything undercuts the prior base, which resets everything and kind of shook everybody out and kind of reset and kind of set everything up for this kind of super powerful move.
Talk about a crazy shakeout. You get to straight up off the bottom. I'm sure, plenty of people bought into that. Talk about it. You don't even get a retest shakeout back in the base. Right. This thing, like you say, it undercuts the base that it was working on, restarts the count. Now you're at stage 1, and then it, never touches its 50-day, it never breaks or closes below its 50-day or 10-week line in this case.
Right. And we were talking a little bit earlier, that bottom week here, you can see it closes well off the lows there. Definitely at least 40%, which is a sign of institutional support, especially during this kind of market correction that you can see in the SPX line.
Correct. And when we get to the daily, we can look at that more in depth, and then also at why the cup is so deep and the handle is a little bit deeper than you would typically want to see. But on a relative basis, not so bad.
Absolutely. So why don't we go ahead and bring up MarketSmith, and we'll take a look day by day.
Okay, so here we are looking at the daily chart on MarketSmith of Schwab during the period of its breakout. Here's the cup and handle we were looking at on its weekly chart. You can see down here, the bottom of the cup on the daily chart shows big supportive action, just like on the weekly. Even better, the other on the weekly closed well up off lows, but down for the week, whereas the bottom day of the cup actually closes positive near its highs for the day, and is accompanied by a big spike above average volume, well above average. We get a couple of days of consolidation on light volume. You can see the big blue up volume comes back in as we're moving up the right side here. What happens here is we get a sharp sell-off in the market. Here we're looking at the S&P 500. If you look at the NASDAQ actually makes a new low here, and this is where Schwab puts in its handle. So relative to the S&P, it matches. We didn't get a new low in the S&P 500. However, on the NASDAQ, we did. So relative to the NASDAQ, if you want to consider that the
benchmark.
The tech heavy index, the index where most of the .com is residing. Schwab was definitely, you see it's an NYSE stock. They've messed up everything now. It used to be anything with 2 and 3 letters was listed. Anything with 4 or 5 was NASDAQ. Now you can have 4 letters. That's an NYSE, so But anyway, back then it was SCH, it was a listed stock and so on and so forth.
Do you want to bring up the NASDAQ quickly to show basically how much stronger this looked versus that index? Because I think it's a very important lesson that higher lows relative to the index is a very big key to look out for during a correction.
So here we go. We can see here, this is the period where Schwab, is that?
Yep, that's when the handle was forming.
That's the period. So yeah, this is exactly where the handle was forming. You can see the NASDAQ clearly broke below the lows. This was the lows of Schwab's cup. This was the handle. So the handle of Schwab's cup held up well below those lows and much stronger than the NASDAQ. However, we can see here, the NASDAQ comes roaring back off the bottom. So we can take a look at the S&P 500, I guess, while we're here, instead of the line at the top. Okay, so now that we're looking at the S&P 500 chart, we can see that it actually did make a lower low, which isn't necessarily showing up in the line chart. And the reason being is because of the close. You see how the close of the actual index was up above the low, and the way that a line chart is calculated, you're not going to see the same low necessarily show up in the line. That's going to show up in a bar chart. And that's why when we go back to Schwab here, we mentioned before, it looked like this held up above. And in actuality, it did not. The NASDAQ and S&P 500 both undercut the lows while Schwab was making its handle, which held up above the low of its cup. That matches the low of the market. So it was really screaming relative strength right here. And then you'll remember, we look back, both the NASDAQ and the S&P 500 just exploded higher. Right. We got to follow. Charles Schwab breaks out on the follow through day. And then you'll see, typically, once I get the break, my goal is always to get that 50-day moving average to be my profitable trailing stop. And here we can go forward a few days. You can see right after it breaks out, the 21-day moving average is keeping in that stock and plenty of time for and here you are, the 50 days already caught up profitable here.
And moving forward just a little bit, we can see this kind of false climax run here. That I'm sure was an interesting period to be holding the stock. So Ross, why don't you tell us a little bit about what that was like and kind of how nowadays you would kind of manage your position?
I try and I try not to think too much, and I don't want to say I figured it out all by myself, because again, I'm sitting there with Bill every day, and I'll tell you, I'm sure it got discussed, and you'd be surprised how many brilliant clients who have been doing this forever, from including the guys with the big names from the big firm, they're asking the same questions. And so they'll, some of the bigger guys talk to Bill directly, and he'll say, hey, I talked to whoever it was at so-and-so, and he was at, so we got, and he would share that sort of thing. So I listen to Bill, but I also I try, like I said, I try not to think so much that, Bill will tell you, it doesn't matter what you think or how you feel. That's why we have rules, right? So I just want to know I'm interpreting the rules correctly and managing my risk along the way. So the question I'm sure comes in, was this a climax? And as we discussed on the weekly, it's just, the first thing Bill said, I heard him say it a million times, because a lot of people would ask about this. And a lot of times when his answer was no, it was simply because it was just too close to the breakout to be a climax. It doesn't really fit the bill. Also, there's the rule that, this run happened 12 weeks after the breakout, if I'm not mistaken. Maybe someone will go back and correct me, but I'm pretty sure it's a climax has to happen at least 18 weeks after the breakout. So it doesn't qualify there. And even though we don't have a 23-day exponential moving average, just by looking at this thing, my eye tells me. So anyway, we're picking up, it has a good respect for its 21-day moving average. And by looking at this, I'm going to say if you had a 23 exponential, which I typically keep on. So even that's usually, all right. So backing up, when I buy a stock, we get the breakout. The first thing I want to do is get that 50-day moving average under me as my profitable trailing stop. So in this case, the 21-day moving average keeps you in the stock all the way until the 50-day catches up to the breakout. Mm-hmm. And it continues to keep you in. And so by the time you get up here, So here's your Climax. You get 1 day close, 3 days of shakeout, and only, well, actually you get a little close below here, but that's so minute and volume is so little. There's probably not much, that's going to worry you at that point.
Right.
And so here you hold, you get a close below, volume declines, and then you immediately recover again. And while you get, even here, you're not going to get stopped out, even if you're using that 21-day moving average as your stop. So just strictly, even if you didn't have Bill there, now I'm a little better at figuring this stuff out on my own. I'm a lot more disciplined at, I'm keeping track of these things along the way, especially if I have a big position in a stock that I want to try and hold for 4, 5, or 6 quarters and really get a solid move out of it. These are things I'm watching along the way. So
right.
9 times out of 10, now the rules will just keep me in there. I know we've discussed this. We've gone through a bunch of stocks now, the model book stocks and others. And what you'll notice with a lot of these big leaders is they're liquid. They'll tend to trade in a very organized pattern and hold key moving averages as well as logical areas of support. And a big reason for that is these are the ones that tend to track big institutional sponsorship and oftentimes the big high quality funds. So if you are getting that on your side and you're at the beginning of the run and an early stage base and everything's kicking and you buy it and you follow those rules, and if you can keep your brain out of it, maybe start, remember Bill only uses weekly charts to help clean up the noise,
right?
And let the stock force you out. And in this case, we'll take a look. If you did that, let's say you sold half on a break of a 23 and the rest below the 50. Even if you didn't recognize the Climax, you're still doing better than 99% of the people out there. I can promise you that.
Perfect. So why don't we fast forward to the actual Climax run, and you can tell us a little bit about how you were feeling on that day and exactly the conditions in which you were selling.
Here we are going back out to the end of Schwab's run. Here was that first Climax-ish move that was only 12 weeks from the breakout, and just a mere double, which at this point wasn't all that, during the dot-com craze, a double wouldn't have been considered a climax in this stock, besides the fact that it didn't meet, as we discussed before, that 18-week minimum rule. And you can look after that. We've got a bit of it's not a base on base because they're not long enough, but it's a consolidation on top of consolidation pattern here. We're holding its 21-day moving average, as we've discussed, and then we tighten up and ultimately break out again. And if you just, again, like if you're waiting for this, if you don't, well, let's talk about the Climax first, and then we'll get into moving averages and that sort of thing thereafter, if you weren't proactively selling the Climax. So here again, we're getting another straight up parabolic type move. In this case, we're up at, what is it? Eight days in a row. 1, 2, 3, 4, 5,
7 or 8. Yeah.
Well, 7 days we were working on an 8th day. If we look back, and I've done the math, the weekly range here is just a bit wider than back here. Here it was about 25.9%. Here it was a little under 25.4%. So you've got your widest weekly range. You've now gone from roughly 30 to 150. That's a heck of a move. If you're talking about the low of the run, you're talking 1850 to almost 8, 9. That's a huge move in a short period of time.
Right.
Not to
6
mention
months,
you've now got you're well past 18 weeks. You've got, and this is almost straight up, you've got the exhaustion gap. And this, I've luckily caught myself cheering in front of the TV on this day. Like I said, it by the time I figured out that we had the definition of a Climax top going, and I was a little too excited, jumping up and down. That's when I picked up the phone, faded myself. I remember I sold it down. I'm going to say at least $6 or $8 off the top. I don't remember if it was just before it fell into the gap or as it fell into the gap. I wasn't slick enough to sell it up on the day that day, but I did get out the very top day.
Right.
And so let's say you didn't, going after that, you can see we break down on huge, and I mean, look how big the volume is when you break down this. It looks like largest volume since, largest volume since the breakout. We're breaking the 21 day. Even if you gave it another chance here, we don't immediately recover. You can see that you get enough sideways action here before it ultimately rolls over and dies to get out with a ton of profit if you bought it properly to begin with and just waited for the stock to force you out. You're not doing too shabbily there.
Right. And would you mind going forward just a few months to show kind of how it rolled over? Because I think this is a very important reminder. No matter how much you believe in this story, this stock, this company was changing the world. It was letting everybody trade if they wanted to. You have to let technicals take you out and have rules, because otherwise it's going to go all the way from where it was at the climax down back to you're giving back at least 50% or more of your profits. So it's so important to follow those rules and have rules in the first place that tell you when to sell based on the technicals.
Right. You'll see there was a 2-for-1 split, which is why you're showing 77.50 here instead of the 155 or whatever it was. And you can see it didn't take very long for it to fall right back to where it started.
Right. So I guess, Ross, any important takeaways for you in terms of this stock and kind of lessons you learned along the way?
Yeah, I mean, I've learned how important it is to be aware of myself, my own emotions, and how that can come into play, and I can work against, but with myself. So, and the big thing is always to try to remember. I always remember, it goes through my head all the time. The market doesn't care what you think or how you feel, which is why we have rules. So, the more, and it's just a perfect example of it. There was no genius here. I bought that breakout. I followed the rules. The moving averages kept me in. And luckily, I'm going to say there's definitely luck in catching yourself doing that. I could have just as easily walked away from the TV set, thought nothing about it, had lunch, and, sold it significantly lower. But this is my one, I wouldn't say it. I mean, this is the one trade I bought from an original breakout out of an early stage base and sold top day. I've never done it again.
Well, perfect. I hope you guys enjoyed this video. If you did, please go ahead and leave a like down below and subscribe if you want to see more videos just like this one. And we'll see you guys in future videos.